This is not a prediction, it's not a price target, and it's definitely not a victory lap. Because the most dangerous moment in any market is not the crash. It's the moment before you think you no longer need a plan. Silver has rewarded patience, but history shows it also punishes attachment. Some fortunes are made by holding, most are lost by holding too long. And the decision that defines 2026 won't be when to buy, it will be when to step aside, without stepping out. Stay with this until the end, because what comes next decides whether gains turn into capital or become a lesson. Welcome to Boring Currency Reports. Now, if you've lived long enough to remember when money actually meant something, this channel is for you. If you value calm thinking over noise, experience over hype, and planning over guessing, take a second, subscribe, not for excitement, but for clarity. And tell us in the comments, where in the world are you watching from today? They had seen this before, even if many refuse to admit it. Every major market cycle begins quietly. It starts with neglect, then disbelief, then slow acceptance. Only later does it turn into confidence. And finally, almost without warning, it becomes certainty. That is the most dangerous stage, because certainty convinces people they no longer need a plan. Silver's rise into 2026 did not feel sudden to those who had followed it closely. It was built on years of underinvestment, supply strain, monetary pressure, and policy distortion. At first, very few paid attention. Then prices moved. Then headlines arrived. And now the conversation had shifted from why silver matters to how high it can go. This is where mistakes are usually made. The problem was not that silver had gone up. The problem was how people interpreted that rise. Many began to believe the move itself was proof that it would continue in a straight line. Gains were treated as confirmation, not as a phase. Risk quietly disappeared from the conversation. In every cycle, there is a moment when investors stop asking what could go wrong. That moment does not feel reckless. It feels reasonable. It feels earned. People tell themselves they were patient, early, and correct. And often, they are right, at least about the past. But markets do not reward past correctness. They only price future risk. As silver climbed, the language around it changed. Caution was replaced with confidence. Planning was replaced with slogans. Those who asked about exits were labeled fearful. Those who spoke about rotation were accused of losing conviction. A trade slowly turned into an identity. This was the illusion of endless upside. History shows that strong trends create emotional blindness. When prices rise fast, the human brain begins to assume continuation. The idea that this time is different does not arrive suddenly. It builds slowly, supported by charts, stories, and selective memory. People remember why they bought, but forget why they might sell. In professional capital management, this mindset is a warning sign. Experienced investors understand that markets move in phases, not promises. Accumulation leads to repricing. Repricing leads to crowd participation. Crowd participation eventually leads to excess. Excess does not always end in collapse, but it almost always ends in underperformance. The most common error after a successful run is confusing a good trade with a permanent condition. Silver's strength had created real outcomes. For many, the gains were not theoretical. They were practical. Debt was reduced. Pressure eased. Options expanded. These were not small victories, and they mattered. But that is precisely why discipline mattered even more now. Because the market has a habit of taking back what is not protected. The business community understands this pattern well. Companies that grow quickly without managing risk often fail, not because their product was bad, but because success removed restraint. Growth without structure becomes fragility. Markets work the same way. At this stage of the cycle, the key question was no longer, can silver go higher? It was, has the easy part already happened? Those are very different questions, and they lead to very different decisions. The illusion of endless upside makes people believe that holding is always safer than acting. In reality, unmanaged exposure becomes more dangerous as volatility rises. The higher the price climbs, the more sensitive it becomes to disappointment, policy shifts, and changing flows of capital. Importantly, none of this requires predicting a crash. Professional exits are not based on fear of collapse. They are based on the recognition that reward and risk are no longer aligned the way they once were. Another trap emerges at this point: media reinforcement. When an asset is ignored, coverage is silent. When it rises, coverage becomes loud. And when it reaches late-stage enthusiasm, the same voices speak in extremes, promising limitless upside one day and warning of bubbles the next. This creates emotional pressure, not clarity. Those who rely on headlines end up reacting instead of managing. The disciplined approach is different. It begins with reframing the situation. Rising prices are not instructions. They are information. They signal that something has changed, but not what to do next. That decision requires a framework. A framework removes emotion from the process. It forces the investor to ask structured questions about value, positioning, and opportunity cost. Without it, decisions become reactive. With it, decisions become repeatable. The purpose of an exit strategy is not to abandon belief, it is to protect outcomes. It is to recognize that capital has seasons, just like markets do. Holding through every phase without adjustment is not loyalty, it is neglect. The illusion of endless upside is comforting. It tells people they can relax, that the hard thinking is done, that patience alone will finish the job. History suggests the opposite. The moment everyone feels comfortable is usually the moment when strategy matters most. They approached the market with numbers that looked precise, but were quietly unstable. Most investors framed silver's future with a single question: how high can it go? The answers came in neat dollar figures, round numbers that felt solid, confident, and easy to repeat. 100, 150, 200. These targets spread quickly because they were simple. But simplicity can hide weakness. Dollar targets feel logical because money is familiar. People earn it, spend it, save it. It seems natural to measure success in the same unit. Yet this is where many strategies begin to fail, because the dollar itself is not stable. A price measured in a weakening currency is not a fixed reference point. It moves even when the asset does not. Inflation, policy decisions, debt expansion, and interest rate shifts quietly change what each dollar represents. Over time, this distortion grows large enough to mislead even careful investors. Using dollar targets in long-term macro trades is like measuring distance on a road that stretches and shrinks without warning. Professionals understand this problem. That is why they rarely rely on nominal prices alone. Instead, they compare assets against each other. This approach is called relative valuation, and it focuses on relationships rather than headlines. For silver, the most useful comparison has historically been gold. Gold and silver share important traits. Both are monetary metals. Both react to currency debasement, geopolitical stress, and shifts in confidence, yet they do not move in perfect harmony. At different times, one becomes favored while the other lags. That difference is where information lives. By comparing silver to gold instead of dollars, investors remove much of the noise created by currency changes. The question shifts from, is silver expensive, to, is silver expensive relative to gold? This change in framing is subtle but powerful. When silver is cheap compared to gold, it often signals opportunity. When it becomes expensive compared to gold, it signals maturity. Not an ending, but a transition. This comparison does not predict tops or bottoms. It reveals balance. Historically, the relationship between gold and silver has moved within broad ranges. Sometimes silver lags for years. Sometimes it catches up rapidly. These swings are not random. They reflect changes in demand, risk appetite, and capital flow preferences. When the ratio stretches to extremes, it attracts attention from institutional capital. That is often when repricing begins, but as the ratio normalizes, the asymmetry fades. The trade becomes fair. Later, it becomes crowded. This is where many investors struggle. Dollar targets tell a story of endless potential. Relative value tells a story of diminishing advantage. One excites, the other warns. And markets tend to punish those who ignore warnings. Another problem with dollar targets is that they invite emotional attachment. When an investor fixes on a number, every movement toward it feels like validation, and every movement away feels like threat. This creates impatience on the way up and denial on the way down. Relative valuation reduces this pressure. It replaces excitement with assessment. Instead of asking, are we there yet? The investor asks, what has changed? Importantly, silver can rise sharply in dollar terms while becoming less attractive relative to gold. This confuses many observers. They see gains and assume opportunity. But professional capital looks at alternatives. If gold offers similar protection with lower volatility at a given point, capital begins to rotate, even if silver is still rising. This is why major cycles often end not with crashes, but with underperformance. The public waits for collapse. Institutions move earlier, quietly through rebalancing. By the time headlines turn negative, the rotation has already happened. Relative value frameworks are designed to detect this shift before it becomes obvious. They do not require speed. They require patience and consistency. The same comparison is applied repeatedly over time. No drama, no prediction, just observation. This approach also guards against overconfidence. It reminds investors that no asset remains superior forever. Leadership changes, conditions evolve. The discipline lies in adapting, not insisting. In the context of 2026, this matters deeply. Monetary systems remain strained. Policy responses remain aggressive. Hard assets still serve a role. But not all hard assets offer the same balance of reward and risk at the same time. Using relative value allows capital to stay aligned with the strongest expression of the macro theme, rather than clinging to yesterday's winner. This is not about abandoning silver. It is about recognizing when its role within a portfolio should change. Dollar targets promise certainty. Relative value demands judgment. One flatters confidence. The other enforces discipline. And discipline, not optimism, is what allows capital to survive long enough to compound. In the next part, the focus shifts from theory to structure, how disciplined investors act when a trade matures, and why stepping back does not mean stepping away. They did not leave all at once. That was the first mistake many others made. When a trade matures, the instinct to act decisively becomes strong. Some rush to lock everything in. Others freeze, afraid that selling even a portion means betrayal of their original thesis. Both reactions come from the same place, an all-or-nothing mindset that markets quietly punish. Professional capital does not behave this way. In institutional finance, exits are rarely dramatic. They are methodical, gradual, almost boring. This is not because professionals lack conviction, but because they understand that precision is an illusion. Markets do not announce peaks. They only offer windows. Scaling is how experienced investors move through those windows. Instead of selling everything at once, they reduce exposure in stages. Each reduction is tied to conditions, not emotions. This allows capital to be protected without abandoning opportunity. It also preserves flexibility, which becomes increasingly valuable as volatility rises. Scaling is not indecision, it is structured humility. One reason scaling works is psychological. When a portion of gains is realized, pressure eases. The investor no longer feels trapped between fear and greed. Decisions become calmer. The remaining position can be managed rather than defended. This matters because the most destructive losses do not come from bad ideas. They come from good ideas held too rigidly. In the case of silver, scaling begins with recognizing that not all exposure serves the same purpose. Paper instruments and physical holdings may track the same metal, but they perform different roles inside a portfolio. Paper exposure is liquid. It can be adjusted quickly. It responds immediately to price and policy. This makes it suitable for active management and rebalancing. When relative value shifts, paper positions are the first to change. Physical silver is different. Physical holdings carry friction. Premiums, storage, and liquidity constraints make them less flexible, but that friction is also the point. Physical metal is not designed for precision timing. It exists to protect against systemic risk, not to optimize short-term returns. Conflating these two roles leads to poor decisions. Disciplined investors treat paper exposure as a tool and physical exposure as insurance. Tools are adjusted. Insurance is held carefully. This hierarchy guides the exit process. When scaling begins, it starts with the most flexible layer of exposure. Partial reductions reduce risk without dismantling the entire position. If conditions continue to shift, further adjustments follow. If not, the process pauses. This creates a decision tree rather than a single irreversible action. Another common error at this stage is confusing selling with surrender. Many assume that reducing exposure means abandoning the macro thesis. In reality, it often means refining it. Capital is not leaving the theme, it is being repositioned within it. This distinction is critical. Markets reward those who adapt early, not those who hold longest. Scaling allows participation in continued upside, while acknowledging that the reward-to-risk balance is changing. It also creates liquidity that can be deployed elsewhere if better opportunities emerge. Importantly, scaling does not require forecasting. It responds to what is observable. Relative performance, volatility, and capital flows provide enough information to justify adjustment without guessing the future. This is how institutions operate across asset classes. They trim leaders and add laggards. They rebalance not because something is bad, but because something has become crowded. For individual investors, adopting this approach feels uncomfortable at first. Selling a winner contradicts intuition, but intuition is shaped by short-term experience. Frameworks are shaped by long-term survival. Another advantage of scaling is that it reduces regret. When investors sell everything and prices rise further, frustration follows. When they sell nothing and prices reverse, denial sets in. Scaling avoids both extremes. Some exposure remains, some gains are protected. This balance is not exciting, it is effective. As silver moves deeper into a mature phase, volatility becomes the cost of admission. Swings grow larger, narratives grow louder. New participants arrive late and act aggressively. This environment rewards those who are already prepared. Preparedness means having rules in place before emotions take over. Scaling is one such rule. It transforms exits from emotional reactions into procedural steps. It shifts the focus from predicting outcomes to managing exposure. In this framework, there is no moment of triumph or defeat. There is only adjustment. The purpose is not to prove a point. It is to preserve capital so it can be used again. In the next part, the focus moves beyond the exit itself to what happens after, and why survival through rotation often matters more than capturing the final surge. They understood something many never learn. Markets do not end. They rotate. After a strong run, the greatest risk is not that prices fall. It is that capital becomes stuck in yesterday's winner while tomorrow, as opportunity quietly forms elsewhere. This is how gains turn into missed futures. Rotation is the discipline that prevents this outcome. In professional capital management, selling is rarely the final step. It is a transition. Capital is not removed from the system, it is reassigned. The question is never, what do I believe in, but where is capital best treated next? As silver matures within the cycle, its role changes. It moves from being a source of asymmetric upside to becoming a source of funding. This does not mean it loses relevance, it means it stops leading. Leadership is temporary in markets. Survival is not. The purpose of rotation is to remain aligned with the dominant forces of the macro environment while reducing exposure to excess volatility. In a world shaped by currency debasement, fiscal pressure, and geopolitical uncertainty, hard assets still matter. But they do not all matter equally at the same time. This is where many investors struggle. They become emotionally attached to the asset that rewarded them. That attachment creates blindness. Every pullback feels like injustice. Every alternative feels like betrayal. Capital becomes loyal when it should be agile. Experienced investors do the opposite. They treat assets as instruments, not identities. When silver outperforms gold for an extended period, the relationship between the two changes. What was once undervalued becomes stretched. At that point, rotation becomes a form of risk control. Capital shifts toward assets offering better balance, sometimes lower volatility, sometimes deeper liquidity, sometimes simply less attention. This is not about chasing what is popular. It is about avoiding what has become crowded. Another critical component of rotation is patience. After selling, there is often an urge to act immediately, to replace one position with another, to stay constantly active. This impulse is dangerous. Activity is not the same as progress. There are moments when the correct action is waiting, holding liquidity, observing, letting excess unwind without forcing participation. In volatile transitions, restraint becomes an advantage. The ability to wait is a competitive edge. Re-entry, when it comes, should never be emotional. It should be conditional, defined by rules rather than regret. The question is not, do I miss the position, but has the asymmetry returned? In the case of silver, re-entry would require a shift in relative value, a widening gap, a return to conditions where risk is discounted and opportunity is mispriced. This does not happen at peaks. It happens quietly, often when confidence has moved elsewhere. This is why frameworks matter more than forecasts. Forecasts encourage prediction. Frameworks encourage readiness. Looking toward 2026, this distinction becomes critical. Volatility is likely to remain elevated. Policy responses are unlikely to normalize quickly. Capital will continue searching for safety, yield, and protection, often moving rapidly between expressions of the same theme. Those who survive this environment are not the loudest or the boldest. They are the most adaptable. Another danger during rotation phases is overconfidence. Investors who navigated one cycle successfully may assume they will navigate the next automatically. But every cycle is different in detail, even if similar in structure. The rules must be applied consistently, not selectively. This includes position sizing. And when an asset dominates a portfolio, objectivity disappears. Every decision becomes personal. Scaling and rotation reduce this pressure. They restore proportionality. They turn stress into strategy. Physical holdings deserve special consideration here. Their purpose is not optimization, it is resilience. They exist to protect against failure, not to outperform in every phase. Treating them as trading instruments undermines their role. Paper exposure is where adjustment occurs. Physical exposure is where stability lives. Understanding this separation prevents costly mistakes during periods of uncertainty. Ultimately, capital survival is the hidden objective behind every professional strategy. Gains are meaningless if they cannot be redeployed. Confidence is useless if it leads to rigidity. The market does not reward loyalty. It rewards responsiveness. The final lesson of this cycle is not about silver itself. It is about behavior. Markets will always offer another opportunity. But they only offer it to those who remain liquid, disciplined, and mentally flexible. Those who confuse belief with strategy often discover this too late. Rotation is not an admission of error. It is evidence of maturity. As 2026 unfolds, the winners will not be those who predict perfectly. They will be those who manage transitions calmly, protect outcomes deliberately, and stay ready for the next imbalance. Because in markets, the future belongs not to the most convinced, but to the most prepared.